Hey everyone, Sandeep here from Price Action Labs. I'm going to be going over the 7th lesson, which is one of the most requested topics I get is how do I find my key levels? And most importantly, how can you use the two things that I use to frame my key levels? And so key levels are one of those things where they're easy to find if you have a step-by-step process, right? And key levels themselves only come down to two major things, right? So for example, this is an ES level here on the 15-minute time frame, and it only comes down to these two things, right? So the first thing is I'm looking for a 15-minute imbalance, right? I'm going to talk about what that is. I'm looking for a 15-minute imbalance, if I spell that. And the second thing I'm looking for is an absorption, right? So this is an absorption. So what do I mean by these two things, right? So what you will find is that the market will gravitate towards very specific areas on the chart each week. And your job is to find where those areas are if you want to trade. So I've made previous videos about how you want to use order flow, how you need the footprint charts. I'm going to be going over how to actually use the footprint charts to your advantage, right? So for example, we had this huge kind of sell-off on Friday the 27th, and I'm going to explain to you why and how, most importantly, you can catch these kinds of trades. So on the ATAS platform here, we see 15-minute ATAS platform. If I just extend this over here to the right, we saw this was our key level, right? So this was our key level. So I'm going to be breaking down why this is a key level and how you can find this key level using the same principles. So if we just take this over to the right hand side, let's break this down. So this here is the imbalance over here. There you go. This is the 15-minute imbalance. Okay, this is like the very obvious one, and hence why this is a very obvious key level. So the way that I find my key levels, step one is I look for this imbalance. This is kind of a, you can call it a 15-minute IMB, right, or 15-minute imbalance for sure. So this is the huge imbalance area, like this very, very big zone. Now, with that being said, I choose the candle before the fair value gap. And the reason I do that is because I want to see this. I need to see price come into the whole zone so it fills this fair value gap before I take a trade up or I take a trade down. That is the basic logic and theory behind it. So every time I choose a key level, I need to see an imbalance and I choose the candle before the fair value gap, right? And what you'll find if you apply this particular technique, you will find that the best place to take entries will come either at the bottom or the top of that zone. Okay, so I'm just going to be breaking down why sorry, this was a key level. And I'm also going to be breaking down how I got my other key levels, which I've had a lot of questions about, but they follow the same sort of process. You're looking for a 15-minute imbalance, and the next thing you're looking for is an absorption. So I'm going to break down what the absorption actually means in this context, right? So let's say we've come into our level like this, right? So I'm just going to be breaking down this one level, but you can apply this concept to any level, right? Or any 15-minute fair value gap that gives you an absorption. Now, the first thing to understand is we are waiting for the market to come into this level. So once you have a key level, you're only really interested in the order flow in and outside the level during the session, right? This is very important. So during the session, what was going on? I'm not so interested in the London session and the pre-New York session. I'm only really interested in what's going on between 9:30 Eastern and 11. Right? This is what I look for. So I've got a whole process on how I find levels and the structure behind it and all these different things. But this video, I'm specifically zooming in on levels, how I find my levels. Okay. And so when it comes to finding levels, it only comes down to two things, right? So I'm just going to make this very clear throughout the video. So we're looking for a 15-minute imbalance. That's the first thing. And the second thing we're looking for is we're looking for an absorption. An absorption basically means this. An absorption means someone's in control, right? So either buyers get absorbed or sellers are in, or sellers get absorbed. So it's either buyers or the sellers. Now, with that being said, let's take this to the charts. And we're going to keep these here throughout the video. So what we're seeing is here on the 5-minute chart, we want to see these sort of rejection sort of things, right? So we've had our 15-minute imbalance. We've chosen the candle before, and we've dragged that zone over to the right. Now, once we've done that, we want to start seeing these sort of rejections. So we want to see this one here. I'm going to put them in red, and you'll see why blue. And you'll see why in a minute. You want to see these rejections, and you want to see these rejections, because when you have a key level, either buyers can be absorbed or sellers can be absorbed. Now, in this case, we saw this kind of meltdown over here. So we see this big meltdown, and the reason why is because of what was going on inside the key level. So I'm going to break down basically the theory behind key levels. And just another quick thing about key levels: your key levels will develop with time. Right, your key levels will develop with time. It's not something you can master from watching one video, or looking at one pair, or just looking at just going on the charts for one day. No, your key levels, they will develop with time, and you don't have to find them exactly how I'm finding them. Right, I just find that choosing a 15-minute imbalance, the candle before, and dragging the line over gives you the highest precision when it comes to finding key levels. Now, that's just me. However you find your key levels, the most important thing is to go through what I'm going to go through now, which is the order flow, the footprint charts, right? The absorption. So I made a little bit of a acronym here just to describe how it works. So this is sort of the order flow method, if you like. So this is the order flow method. So what does the order flow method stand for? So it is O for observe, R for read, D for decode, E for execute, and R for repeat. Right, so we observe what the market is doing. So we have context, structure, premium, discount. We have all these different things. After that, we want to read what the market's actually doing. Now, reading what the market's doing isn't staring at candles, even worse, indicators, Heiken Ashis, Elliott waves, any of these things. Right, reading the market comes down to two things, and that is the bid and the ask. Right, the left number and the right number. So if you watched any of my videos, I've broken down what footprint charts are. I'm going to assume you've watched that video. If you haven't, please go back and see that. So we want to observe what the market's doing, market context, that's structure, dealing range, premium and discount, volume profiles, even maybe the news, stuff like that. Once you've got that, you want to read what the market's doing. We look at bid and ask, we look at volume delta, we look at who is aggressive. Then we decode that information. So then we start looking at the absorption, the exhaustion. We start looking at zero prints. We start looking at who is trapped in the order flow. And then from there, we execute based off the break and retest, right? So we have to do this in order. So the reason I call it the order flow method, or the ORDER, is because we want to observe what the market's doing. So we want to get market context. We then want to read what the market's doing, actually reading it. So I have a quote that those who read the market are paid out by those who don't. So the R is very important, and the R allows you to decode the market, which is D. This is absorption of buyers and sellers. Once you've achieved that, you then want to execute based on what you've decoded. And the most important thing is, once you have O, R, D, and E, you want to put that into a repeatable system with consistency, and that's how you build your edge. And we do that through order flow. So that's obviously through footprint charts, understanding where liquidity actually is, not just using an ICT model. You actually want to understand where the liquidity is. You do that reading the order book, or the orders that hit the footprint charts, and you want to identify weakness. And so weakness is how levels form, because if you think about it, when a participant shows weakness, it means they've been overpowered by someone else. And so we call these passive buyers and passive sellers. I'm going to be going through what that is. But just remember: order, observe, read, decode, execute, and repeat, right? That's the order flow method. Now, if we go to the footprint charts right now, this is a candlestick chart, right? This is what people think they need to trade. So we have our key level. We've gone through O, right? So O is the the observe, right? So I'm going to assume you have your market context correct. You understand where your key levels are. You understand where your structure is. You understand your premium and discount. Now we go to R, read, right? What do you read? What is it that you're reading? Well, here's what you're reading, right? You're reading candles inside the levels. So let's kind of understand what was going on here. Here we have this. So you are looking to read and just understand what's going on. So we can all read a few things, right? So you want to understand the x-axis and the y-axis. Now the x-axis here, it says 1345, which translates to 9:45 EST. Now at 9:45 EST, you are interested because the market is open, the market is in session, right? So ES futures, NASDAQ, they open at 9:30 Eastern. So between 9:30 and let's say 11, maybe 11:30 max, you're interested in what the market's doing at this price, at this area. Now, once you know what to read, now again, this is very important because a lot of people think they can read the market without reading it, right? Or they can read the market by looking at candles, which is not the case, right? It's just not the case. It's not viable to do that. You want to understand volume. you want to understand delta and aggression, right? So delta and aggression kind of mean the same thing. When you have a negative delta, it means sellers are being aggressive. When you have a positive delta, buyers are being aggressive. So you can call them buy volume, sell volume, delta, aggression, you know. So going over here, for example, if you look at this candle, right, what you can see here, just by looking at this candle, what you can see is the bars are greater at the top than they are at the bottom, right? You can see that at the bottom there's sort of that lowish volume. Here there's higher volume. Now what you want to understand is once you have your key level, so I often get a question, how do you find your key levels? So I've been through them, right? I've gone through this over here, for example. So I've told you that, I mean, the levels that I find, they come from 15-minute FVGs. And then I'm just looking to take the candle before. This is very important. I'll just write B. Take the candle before and drag the zone over. So a visual representation looks like this. Find the candle before, drag it over. And you want to start looking at the order flow inside of this key level. K level, right? KL, sorry. So once you've got that, you then want to focus on the rejections. So, you know, more importantly, you want to understand why this is a key level, because going into Monday, right, going into April, this is going to serve as a key level. So ES, if you're an ES trader, you want to look at 64.90 to 65.18, 65.20. And you want to ask yourself, why is this a key level? So this is the question I get. How do you find your key levels? Or the better question is, why is this a key level? And so I'm going to keep the answers up on the screen so you can kind of understand this in real time. So I've just shown you we're at a 15-minute imbalance, right? Or a 15-minute fair value gap / imbalance. And we choose the candle before. That's important to understand. So we choose the candle before. Now, by choosing the candle before, you're giving yourself a better chance of catching these entries, or at least understanding how they work. Here, okay? But in order for us to make a key level, in order for us to understand why it's a key level, we need to follow the order flow model, right? Or we need to follow order flow. Now, order flow specifically I've broken down is this, right? So now we're on the read part. So we want to read, right? Specifically, what are we reading? Delta, volume, bid and ask. So what we can see here is a lot of positive delta, a lot of blue delta. So this blue delta here, what does it mean? Well, the blue delta just means that buyers are aggressive. So we look at delta, which shows us aggression. Who is being more aggressive? So on the x-axis, we can see here 945. Now the y-axis is more important because this was our key level. So 64, let's call it 90 to 64.95. So obviously our level's a bit bigger than that, right? Our level's all the way up here, but we're focusing on the rejections off that level to the downside because we're in a bearish market for S&P 500. And so what does the R mean? You have to read this if you want to trade the lower time frames. If you're a day trader, you cannot get away in 2026 without at least understanding what the delta is, right? There's no two ways about it, right? Those who trade without order flow end up being the exit liquidity for those who do, right? Those who trade, I'll say it again, those who trade or those who choose to trade without order flow end up becoming the exit liquidity for those who do. Because when you trade with order flow, you're trading what the markets are doing, not what you think they should do. And it's a very big difference to It's a very different way of looking at the market, right? The market leaves clues on what it wants to do, what it is doing, and what it could potentially do. That's where key levels come into it. Because when price leaves a key level, I'm going to show you at the end how this develops. When price leaves a key level, and you can actually see why it's a key level, and you know where the key level is because you can prove it with the order flow, not you thinking it bounced off here or you thinking it rejected there. No. If you can prove almost mathematically, if you can decode what the market's doing through footprint charts, you can begin to understand and dissect where those key levels are. And when you can dissect where those key levels are, your trading becomes simpler and more streamlined, right? Because you actually know, I will only take a trade above or below this level if we get there. All right, so that's what you want to kind of understand. So if we go to our acronym over here, we're in the R section. So R means we want to read the bid and ask, the delta, and the aggression. So let's take a look at this. So between 64, let's call it 85 to, let's say 85 to 95, what you sort of want to understand is inside this key level, yes, we had a lot of aggressive selling, but look at the top. Right, look at the top. We are going to go through why this is a key level and how I use this to find my key levels for the next week. So we can see here 39 for 239, right? That's obviously a big difference. The delta here is 200 because it's the right number minus the left number. Now this is the bid on the left number. The bid is the aggressive sellers and the ask is the aggressive buyers. And so when you know you have sellers on the left, aggressive sellers, and you have aggressive buyers on the right, this is half the battle, because now you're simply using the footprint charts to tell you who is more aggressive and therefore who is actually being rewarded in the market, right? Who's being trapped. So this is that's step R, right? So R is about reading, then we start decoding. Decoding allows you to execute. So we just want to understand what the decoding actually means. So when I say decoding, you sort of want to interpret this pretty literally, right? I'm going to break this down. And so what we want to do as traders is we want to start decoding the market based on what it's telling us, not what we want to see. So we're looking at this sort of rejection over here, this first rejection over here. So if we go to ES and we kind of get the footprint charts up next to it, right, what we can see here is, boom, there's our first sort of rejection here. Now, the rejection happened here 9, so the market opens here, right? So 9, this is sort of 9.25 and then 9.30. So this is a big, obviously, red candle, right? So we're seeing bearish activity entering the market. Now, what's important to understand, if you're making any kind of pre-market plan, you need to maybe focus on the first 5 to 10, maybe 15 minutes before the market open, right? The reason I say that is because the market did kind of was hovering in our level before the market opened, right? So this is now 9.25. Here's 9.30 Eastern. So this is 9:30 Eastern. So you kind of want to see what the first 10, 15 minutes prior to the market open was doing. This will give you an indication as to what that key level is doing before the market opens. So what we can see here, if we just zoom in, is we can see a lot of this blue delta inside the candles, right? Yes, we see red delta, but the thing to note, when you're finding key levels, you want to see who is aggressive in the key level, and you want to start decoding it, right? That is the order flow method, right? So right now we are on the decoding, which helps us execute. So what is the market telling us? Again, if there's one thing you want to put into your brain, is you don't look for trades, you read what the market's doing and you just ride the wave. So if buyers are winning, you take buys. If sellers are winning, you take sell. How you decode that is based on what you read. So again, we see here again, this red candle here is quite interesting. So let's kind of zoom into this red candle. This red candle is the same as this red candle here, this one. So this one is this one. Now, when you kind of zoom in, what you see here is you see big red candle, so bearish activity, and we ended up, I think, just breaking that zone, right? Pre-market, we broke that zone. This is now 9 a.m. Eastern. What do you see as we break that zone, right? So as we break that zone, so we're inside the zone, right? Zone and key level, I use those two, that phrase and that word interchangeably, because a zone is essentially a key level. Now, I don't call them supply and demand zones or support and resistance, because I do not know it's going to be a support and resistance until the market shows us what it wants to do. Right, so you do not call them support and resistance, you call them key levels, and you let the market confirm whether it's going to be support or resistance. Now, if we take this a step further, what you want to understand is we had this market open. So here was market open, and this was the rejection back into the zone. Hopefully you can all see that. So we had the market open, break, retest. So for those who trade sort of the 5-minute opening range breakout, I don't trade that myself, but if you're trading the 5-minute opening range breakout, this is for you. Because you're waiting for the first 5 minutes, so 9:30, 9:45, an opening range breakout. So for those who don't understand what an opening range breakout is, an opening range breakout is not about the candles. It is about the level and what the price action is telling you inside of that level. That is the most important thing. So if this is the first 5 minutes like this, right, let's break this down. This is going to be an orb lesson, a key level lesson. So if this is the first 5 minutes, right, 9:30, 9:35, here's the first 5 minutes, right there. Let's put it in yellow. There is the first 5 minutes. In fact, if I just do this, let's break it down. Here is the first 5 minutes, 9:30, 9:35. There you go. So the most important thing to understand is that this here doesn't, you're not supposed to draw lines like this. This is not how you trade orb, right? The opening range breakout. You want to trade orb in line with where your key levels are and the absorption. I'm going to write that down. So when you're trading the opening range breakout, so the opening range breakout, the way to do it successfully is you want to identify where your key level is, which I've explained in this video. You want to identify where your key level is, and you want to time it with a valid absorption. So that's going to be absorption, right? You want to time it with a valid absorption. Now, once you've timed it with a valid absorption, you can then begin to dissect, okay, this is a 50-minute orb. This is a 5-minute orb. We've tapped into a key level. What is the key level telling me to do? Because the orb, an orb is not a strategy. Like, I speak to so many people, they try and explain to me. I ask them, like, well, how do you trade the orb? They're like, oh, I just wait for it. I just wait for the orb. No, that's not how it works. You want to understand where the market wants to trade. So where is the imbalance? You then want to understand who is aggressive in that key level, and does your orb line up with that? So if you're trying to put orb into a strategy, because an orb is just a concept, you want to put orb into a strategy that works, that's consistent, that's repeatable. That's why we use the order flow method here. So you want to observe what the market's doing, you want to read what it's doing, you want to decode what it's doing, you then want to execute based on what you've decoded, and you want to repeat that, right? Because the orb looks different every day. So the orb is basically a key level, absorption, and if you want to put this into an actual strategy, it looks something like this, right? So a strategy is basically, if I spell that right, strategy. A strategy comes down to three things. It comes down to a key level. Then you want to understand where your orb is, and then you want to pair the orb with an absorption, right? These are the three things that allow you to trade the orb, right? Just trading the orb alone without context of key levels, and even worse, without the absorption, is not going to cut it. You need to put it into a strategy. These are the three things that allow you to do that in the long term. So now that we've done that, right, you then want to start understanding where the rejections were. So there you go. There's your rejection. So once you have this rejection, there are different ways you can enter. I mean, you could enter the market as you're rejecting, stop loss above the orb high, target the orb low. This is one way you can do it, right? So if we just hop up to a 5-minute time frame, right, you're looking for rejections off the key level. And so how I find my key levels and how I confirm my key levels simply comes down to the multiple rejections. So here's 1, here's 2, and then here is 3. So we want to be breaking down each and every one of these steps in detail. So here's our first rejection. Here's our second rejection. So there's our second rejection here. So this green candle followed by a big break. Notice how we kind of break the orb or the 5-minute opening range low. Now, this is where I'm just going to break down the order flow method from O all the way to W, right? So let's do that. Right, so let's do that. Let's bring up our friend over here. So I made this little acronym so that people can understand. This is the order flow method, or the order flow system. Now, there we go. So observe, right? We've got our key level. We've observed what the market's doing. Now we want to read a couple of things, right? So we sort of want to read what is going on. So we have the buyers, and so we got the sellers and buyers. We understand that buyers were aggressive here, and we break the downside, right? That's kind of O as well. We're observing what's happening with reading what we need to read, right? We're not trying to gamble off candles. We're not guessing and gambling. We're reading and reacting. Now, once you've done that, you then want to start decoding. So reading and decoding kind of go together, because you want to decode what the market's telling you to do, right? The market's telling you, yes, I want to break to the downside, but we have this massive absorption of buyers, right? Aggressive buyers, because we see the blue delta here. So if you see a lot of aggressive buying over here, what does that tell you, right? It tells you that they're being absorbed, right? The technical term is they've been absorbed. Right? Now, exhaustion, as you can see here, I know the writing's a bit small. Let me make that bigger. Exhaustion, think of exhaustion as what it means literally. Tired, no energy left, defeated, tried and failed physically, right? That's what the word exhaustion means. Imagine you're exhausted, you've tried, and you haven't been successful at breaking that wall or that ceiling. This is how the market creates a ceiling, and this is how resistance is formed. This is how supply is formed, right? So supply is formed when there's an exhaustion of buyers, aggressive buyers. And more importantly, we have zero prints. So I've mentioned here the zero prints and the trapped flow. So trapped and absorption kind of mean the same thing. Buyers are trapped. Or what do I mean by zero prints? Zero prints are one of my favorite ways of trading because having a zero print increases the likelihood of a reversal from that point. Now, in this case, what's interesting here is we actually had a zero here. So we had 0 for 67. We then had 0 for 29. We then had 0 for 21. We actually had 0 for 90 as well. So the more zero prints that I see, the more likely I am to trust that this key level is going to hold in the session. So if we just break this down one more time, let's go to our third rejection over here. There we go. Here's our third rejection. So this is very interesting. So this again, this rejection is here, right? So I didn't take this trade personally. I thought we were it was quite a choppy day in my opinion. I don't really like these trades. I don't like when the market kind of does this, right? So we opened at obviously 9:30. We chopped around until probably 9:30. 11:30. The move didn't happen until 11:35 onwards. So typically I'm not trading at that time. But in terms of the actual setup, right? So for example, you could take a trade at the 5-minute low. You can have your stop loss above the 5-minute orb, or you can have it down here. It's perfectly fine. And the setup somewhat performed, right? I think we had somewhat of a decent set. There we go. We had somewhat of a decent setup, right? Obviously S&P is very bearish right now. ES and NQ very bearish. So in order for you to take trades like this, you want to understand how you find your key levels and why they form as key levels. This is the biggest lesson to kind of take away from it. It's all about levels, right? So levels comes down to two things: 15-minute imbalance and an order flow. Now, how we do that is by understanding, again, let's break down this rejection. We're going to skim through the whole order flow method using every single technique in the book. So we want to observe that the markets hit a key level. Right, there we go. Markets hit a key level. Tick. That's kind of tick. I mean, there's obviously you want to look at structure, you want to look at volume profiles, you want to look at maybe the news. There's lots of other things that go into it. I'm assuming you know how to do that. But once you've done that, the next step is going to be read. Right, read the order flow. So let's bring up the absorption footprint charts again. Here we go. So what are you reading? You're only reading a few numbers. You're only reading a couple of numbers. So it's again zero print, right? 31 for 247. So what's interesting here, when you look at this, right, it's a red candle. We can all see it's a red candle. But the reason this is such a powerful tool and why I think you must be using it is because it's a red candle, but the top third, this wick over here, you cannot see through this candlestick chart. The wick over here indicates to us very, very clearly that there are a ton of trapped buyers over here. That goes hand in hand with our order flow method, right? So our order flow method, again, we have ORD, decode, right? Decoding means understanding what you're reading, knowing what to read, understand what you're reading, and then decode it. So we see the absorption over here of the buyers in this case. So 31, let's just break down this because this is the first one that came to mind. We see it all throughout here because this blue delta means that buyers are aggressive. So we can read the fact that buyers are aggressive. The right number is bigger than the left number. We can read that. But we can also read that we didn't really break above this level. In fact, we had this big red candle to the downside. Right? We even broke below the 5-minute orb. So for those who trade orb, this is how you do it, right? You don't just trade orb randomly. You pick your orb, you understand where your level is, you look at the absorption, and you ride the wave. But in order for you to ride that wave, you need to understand what's going on in the level. And what's going on in the level, so in this case, this level was 64.87, 68.90. In fact, 68.90. Sorry, 64.90, sorry, my number's off. 64.90, you can see here 31 for 247. Now, what's the difference there? The difference there is about, let's say 200 or 210, whatever it is, 215. The delta here is 215. So it shows you, right, that buyers are a lot more aggressive, but they're not being rewarded, right? That's what we mean by decode, and this is where we start to execute. So executions, I mean, people do them in different ways. So for example, if you're an orb trader, I do like using the 15-minute orb. So this would be the 15-minute orb like this, pretty similar to the 5-minute. how you would enter is you would find your key level, that's number one. You would start reading the order flow here, number two, and you would execute either off some break and retest model here, or you can just use the orb. Perfectly fine. If the market's going to move, it's going to move. Now, the reason we moved to the downside is because we had the large absorption. And so that's the biggest level I want you to take away from today. Understanding the fact that, I mean, let's just a basic summary of today, right? Let's just have a basic summary of what we went through today. These are the key lessons to go through. So lesson number one, key lessons from the video. So lesson number one, you can't trade without the order flow. This is lesson number one, right? Hopefully you've understood that by now. Lesson number two, orb is not a strategy. Orb is a concept, right? Orb is a concept. Now, number three is key levels are the clue to the market, right? So that there's actually one thing I didn't finish going through, but I'm going to go through it now. Key levels are the clue to the market, right? And I'm gonna break down what that means in about a few minutes. And the fourth thing to understand is that you need to decode the absorption when you execute. So kind of like number one, but when it comes to execution, you have to have the order flow. So you need to understand what's going on inside of these sort of regions, right? You got to understand this, right? You need to understand. There's no way around it. Yeah, you got to understand all of this. Very important to understand that. Now, let's just maybe take a picture of this, right? Maybe take this, maybe take a picture of this, come back to that. Now, what I want to finish off this video with is basically doing an outlook for Monday. Now, we can see here the S&P 500 and same with NASDAQ, incredibly bearish. I mean, this is an absolute bloodbath. I think I was talking to a guy in the community. I was explaining to him how, January opened here. This is Jan. So this is Jan. Yeah. This is now, we're going into April. It's crazy. 4 months of just continuous crazy. But having said that, right, I am an optimist. I do think the S&P will fly to the upside eventually, right? But when it comes to levels, right, so this is one example of a level. Now, the reason this is a key level, so on the S&P 500, the reason why using order flow in a structured way is so powerful, the reason why using the order flow method here is so powerful is because you can observe and read and decode and execute and repeatedly come back to that system when you're using footprint charts in this manner. Now, the reason I say that is because we have proven in this video, I have proven to you that this is an area of supply, or as some people say, resistance. So this is an area of supply or resistance. Right now, because this is an area of supply or resistance, right, we know that when price comes back into here, right, because we know there was a lot of trapped buyers here. I went through that here several times. We know that just by looking at this. So just by looking at that now, right, if we come back into this area, we can either see the same, or hopefully we see a break and retest and we can go long. So this is a good area to take longs from because the market has proven already that this is a key level. So this is the main sort of thing I wanted to go through in this video, right? So in next lessons, we're going to be going into different type of setups, how to use it with orb, how you can use it with support and resistance, and lots of other things. But hope you found this useful. I get a lot of questions about orb and stuff. So if you have any questions about any ideas about lessons you want to see, feel free to just comment and I'll do my best to deliver.